Hello and welcome to Bloomberg Quint and welcome to Thank God It's Friday, Bloomberg's weekly edition where we bring to you market experts' views. And this time we have joining us Nilesh Shah, who's the Managing Director and CEO at Envision Capital. Nilesh, thank you so much for joining us.
My pleasure.
I'm assuming you're a little bit more relaxed this time around today, given that the Fed overhang is behind us, at least for now. But okay, Morgan Stanley and CLSA, two broking firms, they have reduced the weightage of India in their portfolios. A marginal change, but they've done that post the recent run-up. Nilesh, what is your view? Nifty headed towards 10,000 or we could even see 7,000?
Well, I think 7,000, the possibility of that looks very remote. Of course, you can never say never in this marketplace, but 7,000 looks very, very remote. I'd probably say a higher probability of the market going to 10,000 versus 7,000. I don't think 10,000 is in doubt. It's more a question of whether 10,000 happens in 2016 or whether it happens in 2017 or maybe even later. I think that's really the only the X factor. But otherwise, I think India is on a pretty strong wicket. I think India is relatively well placed. I think the whole downgrade or the reduction in weightage to India, I think, is uncalled for. If at all, the best times for India are yet to come. And our sense is that India is entering a pretty strong growth phase, which we believe is unparalleled, unprecedented in any other part of the world, especially amongst the larger markets. So to that extent, I think we remain very optimistic about India and Indian equity markets going forward.
So you believe India is in a secular bull run phase right now?
Oh, absolutely. I think, and that optimism stems from the fact that we are kind of slated to grow at least at 7 or 7.5% for years to come. It could probably be the most durable growth opportunity that the world is likely to witness for the next 10 or 20 years. And I think that makes us very positive on Indian equities. Because I think when India gets into this kind of a growth phase and with inflation sobering down, I think bond yields will come off, interest rates will come off, and probably equities would be the preferred asset class, not just for Indian investors but for investors all over the world. And I think given that perspective, it looks like that Indian equity markets have been in a bull market and I think are likely to remain in a bull market.
Right, so when it comes to the earnings ratio, well, I was actually looking at the price to earnings ratio for the Nifty for this particular year, and I was looking at 18 times now. It's not astronomical, of course. What kind of earnings is the market factoring right now for this financial year?
Well, for this financial year, I think probably the markets are factoring about 12 to 15% earnings growth.
Right.
That's the kind of band which it is factoring in. The first half, of course, has not lived up to that range.
Yes.
But it's quite possible that a lot of catch-up will happen in the second half. As corporate India again has some favorable tailwinds in terms of lower interest rates, in terms of a buoyant rural economy on the back of a strong monsoon. I think these are some of the factors, and then of course events like the 7th Pay Commission and the Europe and that liquidity coming into the system. It's quite likely that the second half is going to be a lot better than the first half. So it's quite possible that the first half, where we had probably growth of about 7-8%, it's quite possible the second half would be more like closer to 15%.
Right.
So maybe on an average for the full year, we'd probably hit the lower band of the expectation, which would probably be around 12%.
Okay.
But I think post that, I think the years post FY17, I think they could probably be stronger years.
Right.
Because all these factors that we mentioned come into full play.
Right.
We see pretty good signs of the investment cycle picking up. It's quite possible that sometime next year you would also see the industrial capex cycle also pick up.
Right.
So it's quite possible that over the next, say, 12 to 18 months, all the different pieces of the economy, be it the agriculture and the rural economy, the investment cycle, and of course the evergreen consumption cycle. All three play out at the same time. Our problem over the last maybe 10 years has been that at different points of time, it's been either the consumption cycle which has been strong or the investment cycle. Barring that period of 2003 to 2008 when both the things played out. I think we could probably get into that phase maybe sometime towards the end of 2017 or maybe early 2018 is when we'd probably get into that phase.
Okay.
Nilesh, everything is looking very hunky-dory right now. Everybody is only talking about positive triggers. What do you really think is the biggest risk for India at this point?
I think the biggest risk for India right now is the world itself. I think right now India is, people call it the bright spot, the rising star. I think all those are perfect names to kind of give. But I think the world is kind of not looking all that great. The world is a messy place. Growth is anemic. There are large geographies which aren't growing. Be it Japan, Europe, they're still struggling. In a way, the correction in the commodity cycle is putting a lot of pressure on emerging markets. So big markets like Brazil, Russia, Southeast Asia, I think they are having their own challenges in terms of growth. Middle East, these are big geographies which are having challenges. And on top of that, of course, we have this tsunami of liquidity which is playing out for all these years. So I think that itself is a big challenge, and these are things which are not sustainable. At some point of time, there is going to be a course correction. And when that course correction happens, I don't think India is going to kind of be an island of safety at that point of time. There would be those few days, those few weeks, or maybe even those few months where even India would be vulnerable to some of this impact. But otherwise, I think the rest of it, I think purely from an India standpoint of view, I think looks pretty good. Right. So if we have something going wrong with the global economy, especially with the global financial system, right. I think the actual global economy, I think, is already kind of impaired. Right. But I think the global financial system right now is robust. Right. But I think that's probably the most vulnerable.
Right.
So you think that we could see some opportunities, some of the long-term investors who missed out on this rally that we've seen past our budget, do you think there could be some buying opportunities that are likely to come up?
Oh, absolutely. I don't think you have any bull market which just goes on and on without corrections and consolidation. Correction and consolidation are an integral part of a bull market, and we've seen this bull market. So if you kind of look back to the period of, say, 2003 to 2008, we've had years like 2004, 2006 when the indices corrected 15-20%. Right. Even the start of this calendar year, we had a situation where the indices did correct 10-15%. So I think those situations and those scenarios will always be there. So even over the course of the next 12 months, as the bull market continues to unroll, you would see situations where there are corrections of 10-15%, I think, which will present some really good, significant long-term investment opportunities. Okay. Those would be opportunities for investors who are not there in the market. Those would be opportunities for investors who want to increase allocations. I think those would be wonderful opportunities.
Okay, so we were just talking about global cues right now, and I want to tell you guys that at least as far as Bloomberg goes, we have about 86 analysts on the Bloomberg consensus, and all 86 analysts on the Bloomberg consensus are expecting a Fed rate hike of around 25 basis points. Nilesh, my question is, how much of a difference does it make if we have a 25 or even a 50 basis point rate hike from the Fed? Are we too over-concerned about this particular fact?
Well, the way financial markets kind of function, they really don't go by that specific number. Right. I think sentiment gets driven a lot by the direction, right? The message that you are conveying. And the reality is that the last 5 or 7 years, financial markets have been driven by the central bankers. Right. It's honestly not the investment managers, but it's essentially the central bankers who are really driving the markets. And I think when they kind of take a hawkish view, interest rate hike is that 25 bips really is not going to make a material difference. Right. But the markets would interpret that as the central banker taking a hawkish view. And then when you have a 25 bip hike happening, the markets will start factoring in, so okay, now the next hikes will be there sooner rather than later. Right. And that's something which unnerves investors, number one. Number two, we've seen actually an extended bull market in global equities with the negative bond yields. Right. Okay. So we are at a scenario globally, I'm not saying this in the context of India, but globally, is that over the last 12 months, investors have bought bonds for capital appreciation and they've bought equities for yield. You don't see this happening. You buy bonds for yields and equities for capital appreciation. Right. But globally, with interest rates falling so rapidly, interest rates turning negative, okay, you have this scenario where investors are saying, okay, now how much lower can interest rates go, and therefore how much will bond prices appreciate, and therefore let me just go out and buy bonds.
Right.
And for equity, saying, okay, how is the earnings yield?
Yeah.
And if I can borrow money at say 0% or 0.5% and kind of buy an earnings yield stock, which is giving me a yield of 2, 3, 4, 5%, that's a wonderful arbitrage. Okay, and I think that's a huge paradigm shift, which we've seen over the last 6 to 12 months in global financial markets. So I think if there would be a hike, you would again see a reversal of this paradigm shift.
Right.
When investors again say that, oh, now interest rates are going to go up, the dollar is going to strengthen, and if the dollar strengthens, will that kind of unleash another round of competitive devaluation of currencies by emerging markets, which in turn leads to a currency war, so to say. So I think a virtuous cycle becomes a vicious cycle. And that really kind of is the worry which investors always have about the next move of the central banks.
Right, but we're factoring in about 25 basis points, and I'm sure a lot of the markets out there have already taken that into consideration right now.
Yes, I think so. And the fact that the markets have rallied, but rallied for a day post, the US Fed meet, is because there is a concern saying, yes, it's not happened this time, but it's just got postponed to December, and the probability of a hike in December just goes up to that extent. So I think somewhere it's still a wait and watch mode in which investors are in. And it looks very likely that if the US Fed at the start of the year had said we will have a rate hike, I think it would be difficult for the US Fed to kind of come out of that situation. So I think it's quite possible that there would be a rate hike in December.
Nilesh, on your preliminary analysis and interactions with some of the companies, what is your reading on the rural economy? What I mean to ask is, has the rural demand, do you believe it has seen some pickup led by monsoons? Because the commentary from managements after Q1 earnings was not overtly exciting.
I think in a way, managements have become a little cautious in terms of painting the future, and that's because over the last 2 or 3 years, their optimism has been found to be unfounded, in the sense that they expected things would turn around very soon, but it didn't happen. So we had a pretty bad monsoon in 2014, and so probably managements thought that 2014 was an aberration and things will get better in 2015. 2015 again we had a deficient monsoon, because of which the rural economy even turned worse than what it was. I think 2016, yes, the monsoons are good, but I don't think the managements want to get carried away, saying that there's going to be demand which will get generated on an overnight basis. I think the managements want to kind of take one step at a time and figure out how this will play out. I think they just want to see how things are going to play out. I think if, for example, between now and Diwali, there is a good demand, I wouldn't be surprised if management starts saying that FY18, which is the next financial year, is going to be a lot better than FY17. And in fact, you're seeing some of the consumer durable companies, for example, already talking very positive, already being very optimistic, saying that if last year or last 2 years we've grown at 10-15%, we think we have an opportunity to grow at about 20 to 25% in the coming season, which is basically between now and Diwali or between now and Christmas. So my sense is that managements will kind of slowly raise their guidance, let me put it this way, and I think they will take it quarter by quarter. I don't think management are going to step in and say that, okay, the whole of next year looks terrific. I think they're going to take it quarter by quarter.
Nilesh, I also know, what do you think are really some of the emerging themes which have the potential to give you double-digit sort of earnings growth?
It looks like that the entire consumer basket, and I'm more so the consumer dictionary guys, I think for them the tailwinds have never been so good, the tailwinds that we are seeing right now. I don't think have been so good in the last maybe 5 years or so. So you look at it from all points of view, because of 7th pay commission, because of ORO, purchasing power is going to go up, number one. Number two, the ability to borrow is going to go up because interest rates are lower versus where they were 6 months, 12 months back. Third, the choice has gone up for the consumer because you're seeing more and more players coming in, thanks to online, thanks to digital. You're seeing more choice for the consumer. And fourth, of course, is the feel good, which is likely to come in because of a monsoon. And the fifth is that you're going to see 2017, especially the first half of 2017, is basically an election-packed period. And what we've seen generally in the past is that a lot of spending happens before elections. And when there's a lot of spending, you actually see a demand for consumer durables, consumer appliances going up. In addition to that, the Government of India's initiatives like LPG for all, okay, homes for all, though of course these are slightly medium term to long term kind of aspirations and targets, but I think all in all, the tailwinds I think are fantastic for this sector, for the consumer appliances sector and the consumer discretionary space. So I think in that kind of an environment, a whole host of companies, be it companies which are into kitchen appliances, companies which offer cooling solutions, companies which offer travel solutions, tourism related solutions, hospitality. I think there are a whole bunch of opportunities which I think are likely to do well going forward.
Hospitality, tourism is definitely something that all of us look forward to and we like. Okay, just some trends that I want to share with all the viewers. Now, if you just look at the sectoral performance over the last 3 months, metal index has rallied about 17.5%. Auto index has run up by about 15%. Nifty in the last 3 months has returned about 7%. Whereas IT, that has given you a negative return of 9.4%. And Agam, that's a question that you have.
Oh yeah, so we've had at least one prominent brokerage out here who's made a tactical decision to increase their weightage in IT, and this is their reason, of course, is that IT is beaten down so much. So, and I know that you track this sector very keenly. What is your view on this sector, at least in over the next few quarters?
Well, in the short term, it looks like that there are headwinds facing the sector. There's really no doubt about it.
Yeah.
The spending on technology, I think, has become a lot more measured, a lot more calibrated.
Right.
I think especially in principal markets like US and Europe. So I think that's clearly a headwind which is facing the IT companies, number one. Number two, the other headwind is basically the duration of projects. The duration of projects has become a lot more shorter versus what it used to be, and therefore when projects become shorter, your performance can become a little more lumpy, a lot more volatile versus the secular growth rates that we have seen in the past. So I think these are the two big challenges which I think apply to the entire sector.
Right.
But I think it's not for the first time that the sector is facing these challenges. Earlier on also there have been challenges, and every time the IT sector, India's IT sector has come out stronger.
Right.
And I think the principal proposition is basically the wage differentials, which are prevalent between US and markets like India. And I think a simple barometer is that if the average per capita GDP in the US is about $50,000, so that's about 30 to 40 lakh rupees. So any IT engineer or software developer could anyway be taking say 40-50 lakh rupees a year. Versus that in India the cost is still 4 lakhs, 5 lakhs, 7 lakhs.
Absolutely, yeah.
Okay, that arbitrage is still there.
Right.
While we may not want to kind of really say it in this kind of a fashion, because then we'll be seen to be again the sweatshops. But this reality is there. This is the reality of offshoring. This is the compelling proposition of offshoring. And as long as this gap, and this gap is not going to disappear overnight. This gap is going to take several years. Even if India grows at 8% and the US grows at 2%, that 6% differential will take several years or a few decades for that gap to kind of narrow down.
Absolutely.
So I think that proposition remains. But in the short term, the specific challenges will remain. However, having said that, prospects of the sector are one thing and valuations are the other. So if you really look at the last 5 years, the Indian technology companies have grown at about 15 to 20% over the last 5 years. Some of the smaller, more nimble companies or the mid-sized companies have grown at 20%. These are companies which are reporting operating margins between 15% to 25%. These are companies which throw free cash flows up significantly. And on top of that, post the corrections, the valuations have become very attractive. So even if you forget the forward earnings, but even if you look at the trailing earnings, most of these companies are now trading at about between a band of 15 to 18p multiple. Versus the market itself on trailing earnings basis is trading north of 18 times.
Right.
More closer like 20, 21 times.
Right.
So I think the technology sector is already trading at a steep discount to the overall market. So my sense is that the sector is going to be here. Prospects will remain good over the next many years.
Yeah.
And I think this weakness that we've seen over the last 1 year, or maybe we might continue to see over the next 1 year, I think would be a fantastic opportunity to buy some of these technology companies, especially those technology companies which have a differentiated offering,
Right.
Which are kind of focusing on one segment, are niche players, and therefore would have better tailwinds of growth,
Right.
versus some of the big boys.
Yeah.
So my sense is that I think we should stop, in a way, painting the entire sector with one brush.
Right.
Every company has its own strategy, and I think we need to really figure out that which company is relatively better positioned,
Right.
versus the entire sector for the foreseeable future.
Right. Okay.
Is there any stock that if you cannot talk about stocks, is there any theme that you regret buying or you think you sold off too early?
I think, that is always a challenge in a bull market, because in a bull market you have sectors across the board. But I think, for example, as far as we're concerned, we're more focused on linear secular growth opportunities. So we in general prefer companies in technology, consumer, pharmaceuticals, engineering. That's the kind of pack that we as investors prefer to invest in over a 3 to 5 year horizon. Whereas in the last 6 months, this uptrend in the market has been more driven by cyclicals, rate sensitives, or commodities like sugar, chemicals, steel, all of that. So you could of course easily say that this was more a trading pullback and this was more a beta play and all of that.
Yeah.
But whatever it is, so in the last 6 months we've really not been present in this kind of a segment, because our view is more about investing for the next 5 years. So to that extent, in a way that you could say that yes, we've not invested in these sectors, and therefore it could be a miss. But I think over a period of time, these are kind of situations where it's best left to ignore, as long as they're in conflict with your investment philosophy.
Anything that you think you sold off too early?
No, not really, because I think by and large we've been having a buy and hold approach. So we've been holding stocks for the last 3 years, 4 years,
Okay.
5 years, 6 years, and I think by and large all of them have been in a secular kind of an uptrend. So to that extent, I think it's been fine. Even if you've sold off something, you kind of buy something else, which in turn also goes up.
Okay.
So yeah.
I think he has made his money. He's happy with how things have turned out.
So in business school, we learned that the younger you are, the higher risk profile you're supposed to have in your investments. And this brings me to this certain age group that I've come across, around 25 years old to 35 years old. And a lot of these guys are absolutely against equities. A majority of their savings are with realty or gold or fixed deposits, for that matter. Do you have a message for them?
Oh yeah, absolutely. I think it's a pretty strong and a long message, but I think it's backed by data. So I think if you really look at it over the last 10 years, 20 years, 30 years, over these longer periods of time, equities have beaten all asset classes by a huge margin. So I think and I think we're also used to seeing property prices go up over the last 5-7 years. But 5-7 years is fine. But I think if you look at 10 years, 20 years, 30 years, I think equities have beaten properties by a huge or a wide margin. Number one. Number two, I think, and this is again on a pre-tax basis. On a post-tax basis, of course, equities becomes an even more attractive asset class. Even if you look at the shorter duration, say you take the last 5 years, at best a bond or a fixed income would have delivered to you probably a 7, 8, 9% kind of a return. Whereas equities would have given you between 15 to 20% returns, depending upon what kind of a index you are invested in, or depends on what kind of a fund you're invested in. So I think on the whole, my sense is take advantage of your age group. If you are younger, then I think it makes sense to kind of have a disproportionate allocation to equities. Equities is probably the best way to beat inflation, and so to that extent, and I don't think, of course, anybody's missed the bus. I still think India has got a long way to go, and take that 5, 10, 15, 20, 30 year horizon. You have age on your side, so go full blast into equities.
Okay. Having said that, of course, stock selection really remains important, and of course, your time period really needs to be much longer. That's an important thing to know.
Yes, I think post allocation, it is always your selection which matters. I mean, be it property, be it fixed income, be it equities. I think across the board, one allocation is one part of the decision, and then selecting the right fund, selecting the right portfolio, selecting the right stock makes all the difference to your returns.
So I often get to hear that dealing with the stock market is a multidisciplinary space. So beyond the stock markets, do you have any parallels that you've drawn that have influenced you as an investor?
Yeah, so I think some of the principles which are there, some of the things in your daily life in terms of patience, discipline.
Right.
I think that's where really your temperament comes in, and I think equities is perhaps, if not more, but as much about temperament, because there will be those situations where things are bad or things are too exuberant, and you need to be able to take a step back and say that this is probably I need to be more balanced. You need to display a lot more equanimity in equity markets. So I think these personal traits, according to me, are extremely important. So I think that's where a lot of things which you see in your personal life have a bearing in the way you kind of manage equities, and I think that's very, very important.
Nilesh, nothing to do with companies which are listed, but any e-commerce firms that you really like, the way they operate or their business model, or any company that you wish was listed?
I don't think there are too many. I don't think there are any e-commerce companies which make money as yet. That's the tough part of it. So I think and of course you don't know enough about them from the Indian companies which are there. So I would wish that more of them turn profitable, and I think once they turn profitable, then it expands our investment universe and it gives you an opportunity to kind of really make money. But I think some of the global companies, some of the global e-commerce companies is I think like things like Amazon, for example. I think what they're doing is incredible. And I think they have built a strong moat, and I'm quite sure that over the next 5, 10, 15 years, they will be a lot more valuable versus where they are today. So I think probably we as investors have a small window to invest overseas, so you could probably take advantage of that window which is available to you to invest into international markets. But I think from the Indian space, I don't think too many of them are making profits or making cash flows.
It's too early.
It's too early, yes.
Okay.
Yes.
So, well, it is a weekend and we want to know about your plans, and for our viewers, we want you to recommend them a couple of books that they can go ahead and read for the weekend.
Yeah, so I think, obviously the way I spend my weekend is ideally to kind of go and watch a movie. I mean, as long as there's a good movie around. I just saw Pink 3 days back.
Yeah.
And I don't know if there's a good movie, but I think the first thing I'm going to do when I head home is to kind of really look at what are the kind of new releases. And hopefully, go for a movie. So that's the best way to kind of spend the weekend for me. I think, yes, reading I think is very, very important. I think to me that's one simple habit which I think all people need to develop to be kind of, successful investors. I think the books that from which I have benefited tremendously are books written by people like Peter Lynch, The Peter Lynch Way of Investing, and then some of the books of Buffett. I think there are enough books written on him. I think these are wonderful books to read. I think in addition to that, because we are now in a digital world and a lot of new things are happening, I think it's important that apart from books, it might just be very useful to go and read the annual reports of companies like Amazon and Google and all of that. I think these are the kind of commentary which these companies write or their CEOs write. I think it helps to kind of get a peek into the future and see how things are. So I think it would be a fantastic combination where people like Peter Lynch and Warren Buffett are of the old school of thought, saying look for value in established companies. But here are companies like Amazon and Google who are all about the future. And I think that should, make good reading.
Well, I'm absolutely certain, in fact, that going through the annual reports of something like an Apple or an Amazon will certainly, I'm personally going to benefit from something like that, and that's a brilliant idea. So, Nilesh, thank you for that.
That is all that I can think of right now is good food and a good movie, like you just said, being a Friday. And I just realized we are also a part of that consumer who's driving all of these restaurants and businesses and your PVRs and Inoxes. But yes, so That's we need to thank him for coming in.
Thank
It was
you.
a fun conversation,
Yeah.
Nilesh.
Thank you.
And
Thanks.
for all you viewers, thank you so much for joining us. We hope you gained some insights, and we will see you back at the same time on next Friday. Thank you so much for watching Bloomberg.